Hello, everyone. This is Jelena Ogilvy with Principal Wealth Partners, inviting you to a very informative event, Guide to Retirement. My special guest is Katherine Roy, the Chief Retirement Strategist and Head of Individual Retirement for JP Morgan. She specializes in identifying themes, strategies, and solutions for individuals in key stages of their lives. Consistently ranked in the industry as a top speaker, she has been interviewed and quoted in the financial press on a variety of retirement topics. She also leads an award-winning program that provides guidance to hundreds of thousands of financial advisors each year on this topic. Please enjoy this 40-minute discussion as she highlights retirement planning considerations, which include Social Security, recent legislative changes, and evaluating a Roth. Enjoy. Welcome, everyone, to our event today on Guide to Retirement. We are so fortunate to have Katherine Roy, the Chief Retirement Strategist from JP Morgan, with us here today. I personally spent over 8 years at JP Morgan and witnessed firsthand the power of her leadership in this space, both with financial advisors and individual investors. So Katherine, we're thrilled to see you and welcome to our event.
Great to see you, Jelena. Thanks for having me.
No, not at all. I know that this is an incredibly important topic, and I think it's very timely given what we have experienced this year with the pandemic. So the plan is to hand it over to you and for you to provide some comments, and then we'll finish with maybe a couple of questions if that works.
That's perfect. Yeah, and I thought I would really focus in on three really timely topics in relation to, both the pandemic, what we've learned this year, what we've been hearing in terms of the impact of this year on important programs like Social Security. And then lastly, we have to remember the Secure Act did pass at the end of last year. So revisiting your plan and making sure that it's up to date is the third topic I thought we would tackle.
That sounds perfect.
Okay, so as I share my screen, one of the things that I think that I am taking out of 2020 is trying to imprint upon myself the market volatility that we experienced in March and some of the learnings that we can take away from that period of time as we think about planning for retirement, this really important and exciting life stage. And it's been great that the recovery has been as quick as it has. I know we've had recent volatility as well, but not to the degree that we experienced in March. But for me, it was very much a learning lesson as we talked to both advisors and clients about how should an individual think about handling that volatility and what messages really could be helpful as people try to stay the course through that period of time. And so I want to start here because I think it starts to tell the story of why retirement can be pretty complicated and feel a little overwhelming as you're planning for this life stage. This is as a result of research we did several years ago, and this was drawn up on a whiteboard that really, I thought, crystallized these various factors that go into the retirement equation. And the reason why it can be quite stressful is, one, there are 6 of them, but 2, you don't have complete control over your journey. And so what we often find individuals do or couples do is they tend to focus on, as do I, the green circles. And those circles at like 2 and 4 o'clock on this wheel, those are factors that you have no control over. You have no control over what happens in the markets, nor do we have control, other than to vote, over what happens in Washington, whether it be stimulus packages or not stimulus packages, retirement reform, Social Security, which we'll talk about, or taxation. Those are all out of our control. So the more we worry about those 2 circles, the less productive we're going to be. It's not going to be productive in terms of getting us to our finish line. We have some control over how long we work and how long we live, but the good news is those purple circles really show the factors that will dictate your success, and you have complete control over those factors. So first, it's how much you save versus how much you spend, and second, it's how you diversify using an asset allocation and put eggs in multiple baskets so that you can weather market volatility, and also location. You might be thinking, what is asset location? It's really making sure that you have good diversification from a tax perspective. Pre-tax 401ks, traditional IRAs that offer tax deferral, Roth accounts, taxable assets. Having that healthy mix is an important factor of being successful in retirement as well. But as we think about March, one thing we learned is often as people worry about those market returns and we get whipsawed around, they often react to what's known as loss aversion. And what loss aversion is, it's been proven that losses hurt much more than gains feel good. And so what may be a tendency for some people is they experience bad days in the market, is they feel like they can take control, sell out of the market, and sit in cash until things feel better. And what we know is that that may result and is likely to result, as we see on this next slide, in missing some of the best days, which can happen very closely thereafter. So this has been one of our most popular charts this year from our Guide to Retirement program, the impact of being out of the market. And what it's showing you is a $10,000 investment, portion of an equity portfolio invested in the S&P 500. If it had stayed invested for the 20-year period from 2000 through the end of last year, this investor on that $10,000 investment would have generated about a 6% return and have $32,000, a little bit more than that today to have in their account. However, if loss aversion and that need for control set in and they sell out after some of those worst days, what they're essentially doing is locking in those losses, and they're very unlikely, as I mentioned, to get back in time to benefit from those strong returns of those best days, which are really important to a portfolio's rebound. And so what the remainder of the bars in this chart show you is just how impactful it is to miss the best 10 days that follow, 20, 30, et cetera, and how that really erodes the value of that investment as a result of missing those best days. In the kind of floating box in the middle of the page, you'll see 6 of the 10 best days occurred within 2 weeks of the 10 worst days. And we give you the example in 2015 of those days happening very close together. We had another pairing in March. So March 12th was the 4th worst day in the last 20 years. March 13th, the very next day, March 13th, was one of the top 3 days in the last 20 years. So that shows you how extreme that volatility was in March. And then on Monday, March 16th, we had another, I think, top 5 bad day in the last 20 years. And so those are very tight together. And what's interesting is we often get asked, well, which return comes first? Is it the bad or the good? Well, overwhelmingly, 6 of those 7 best days now that we're counting happened after a worst day. The only example that happened where the worst day happened after the best day is that March 16th. That's the only one in the last 20 years that has experienced that. So generally, those bad days come first, and they're followed very closely thereafter by these best days. And so as we think about and memorialize maybe that experience in March, I think it's important to remember an anecdote that Sam Azzarella, a colleague of mine, as we talked about this, pointed to. You have to live through the thunderstorm in order to benefit from the rainbow that follows. And so thinking about market volatility that way, I think can be really helpful. And just to maybe go one step further, we asked the question, how valuable is actually the very next day, thinking about that March 12th and 13th example from this year. And what we found is that it's pretty valuable. And so what this chart is showing you is, again, that same fully invested column on the far left, but the examples on the far right for bars in this bar chart are showing you, if an investor leaves the market after a day that experienced the negative return that you see, ranging from -5 to -8. So each time the market experienced that, they pull out of the market. They stay in cash for just one day, and then they buy back in at the end of the following day. So they're only missing the day after that poor return. You can see how much their return is eroded as a result of just missing that one day. So it's really important, I think, to hopefully memorialize these memories as you think about investing for the long run and how important it is to stay invested through these volatile times. And then I think the last piece here in terms of what we learned in March that I wanted to cover is, I think, another area that some of you may need to do a little work on, and that is making sure that you have a sufficient emergency reserve fund. I think that's also a key learning from 2020, that life happens and life can be unexpected. Yet less than 50%, according to the Aspen Institute, less than 50% of Americans have about 3 months or up to 3 months worth of liquidity in terms of their spending to be able to weather that unpredictability or what life throws at us. And so I just want to remind everyone, having that short-term reserve is going to be important wherever you are in your life stage. And that's because if you look at the bottom chart here, that 1-year rolling period, if you were in March, and let's say you had a medical bill that you had to pay, or you had a roof that needed to be replaced, you don't want to sell investments and lock in, more than a 30% loss in order to cover those types of expenses. So having that liquidity in cash for those types of situations is really important. And obviously the recommended range is 3 to 6 months worth of your total expenses, having liquidity that is equal to that. Now, on the flip side, when we think about retirement, we want to really make sure that we're using time to our advantage. And time means more time in the market, means more wealth available to support you in retirement. And we see that very clearly, again, on the right-hand side with that long-term goal, having a heavier weight to equities. That is really supported by, again, the bottom chart. If we look at the 5-year rolling period grouping, so again, equities are blue, fixed income is gray, and the mixture 50-50 is purple. So just over a 5-year period, so all the 5 years back to 1950, if we just rolled through them, none of those have had a negative return over that period of time. So while retirement can be 15, 20, 30 years, either to or through retirement, again, we need to think about that's a very long period of time. Even if you just have 5 years, being fully invested can help you diversify across stocks and bonds, make sure that you're not losing money through that period of time. And on the 20-year rolling period on the far right, you'll notice that obviously the bars shrink as you have longer holding periods. And that's really the mindset we need to be taking forward as we think about saving for or living in retirement, thinking about having that diversification to help us with the growth we need either to accumulate wealth or to keep pace with expenses like healthcare inflation. And so moving to the next, I think, key topic, if we can memorialize that learning in terms of what to do through the market volatility and staying the course, both to take advantage of those best days, but also to accumulate wealth for our retirements. A key decision that you'll need to make as you approach retirement is when to claim Social Security. So I wanted to go through a couple things here in terms of just some facts around what you need to know when making your decision. So some of the quantitative facts around how Social Security works, but I really would encourage you to talk to an advisor because Social Security can be both a factual and also an emotional decision to make and to coordinate if you're married or have a partner. Make sure you're making the right decision there. And that's really where an advisor can help you as you build your own personal income plan, how this factors in best for you. But there's some things I want you to know before you do that. So this slide is showing the impact or the importance of your decision on when you claim Social Security and the impact of that decision on the percent or the amount of the benefit that you've become entitled to, the percent that you'll actually receive. And so Social Security is calculated on your 35 best years of earnings or years of earnings. And so oftentimes I hear from people, a key question that I'll address here, Katherine, I worked for 35 years in my primary career, and now I'm doing some consulting, I'm working part-time. Am I penalizing myself? No, your benefit is going to use your 35 best years of work. And so additional years at lower income has really no effect on your benefit. Now, the opposite could be true, though. I took some time off or I didn't work a full 35 years. Well, you have some zeros that are factored in right now. And if you keep working and earning additional dollars in additional years, you can increase the benefit that you receive because it's recalculated every year, even when you're receiving it. And so when we look at this top swim lane, let's just break this down in terms of obviously the people who are turning 66 this year. They're represented in this top swim lane, or the top kind of purple arrows that you see here. So people born 1950 or earlier, their full retirement age is 66. And full retirement age is this technical term for Social Security. That is the age at which you're eligible for 100% of the benefit that you have, that you're entitled to, that your earnings history with the Social Security formula is the benefit that you can receive 100% in that year or at that age. Now, if you had claimed at age 62 and you're in this age 66 full retirement age cohort, you would have lost permanently 25% of your income benefit. So that's off the top and that is permanent. So you would receive 75% of your benefit for life. And on the flip side, for each year that you wait between full retirement age and age 70, there's a concept known as delayed retirement credits. And what that means is that you get an 8% credit or an 8% increase in your benefit amount for each year that you wait. So here in this example, there's 4 years between 66 and 70. So they can, if they delay till 70, get 132% of their calculated benefit. Now, the bottom swim lane is showing for people who are turning 60 this year, their full retirement age is age 67. And so they're going to be greater penalized if they take it early because there are more years between 62 and 67. So they'll receive 70% of their benefit if they claim early. And also, on the flip side, they will have only 3 years of ability to take advantage or benefit from that delayed retirement credit. So they can maximize at 124%. And everybody in the middle, between age 60 and 66 this year, you have this kind of weird numbers of months that are being added on to 66. And so, you can look up your own age there. And one of the reasons why this chart is so crazy is because it is the result of major Social Security reform that was passed in 1983. And I think it teaches us, maybe as we step into the future of Social Security, it gives us a lesson from history as to how Social Security has been reformed in the past. And so just to give you a quick overview, it was passed in 1983, the last time Social Security, the trust fund, was going to be tapped or used to pay for current beneficiaries. And so Ronald Reagan and Tip O'Neill got together and said, you know what, one of the things we should do is pass this, change in full retirement age. Let's move it from 65 to 67. But they didn't implement it overnight. They gave it basically a 20-year grandfathered period. So anybody from, let's say, 42 onwards didn't have any change in their full retirement age. It was 65. And then from between 2001 and 2005, we did the first move from 65 to 66, and then we took a break. And beginning in 2017, we began the move from 66 to 67. So a very gradual implementation, protecting people that were close to receiving Social Security or already receiving. They were protected and didn't experience any change. And so that's what we see likely to happen going forward. We'll talk a little bit more about that as we get into the economics of Social Security, but just wanted to highlight that here because I often get a question around, well, why are we adding all these months? It seems kind of crazy. It's not going to be this complicated, hopefully, going forward once we get to 67 as everyone's full retirement age. But just wanted to make you aware of that. So this is point number one. Then point number two, you might be asking yourself is, well, Katherine, if I claim early, yes, I get a smaller check, but I get that money in hand and I get more checks. So then the question might be, how long do I need to live to make waiting for those bigger checks actually give me more out of Social Security? And so this chart is showing for a maximum wage earner, so someone who paid in at the wage cap, which is kind of the maximum that gets taxed in terms of your earnings for 35 years of their working history. And so at 62, as you see kind of halfway down the slide with that purple grouping, if they claim at 62, about $2,300 per month, you see the purple bars growing. The bar represents the total value they've collected. So you see it growing a little slower than the other examples. But by the time they get to age 76, they would have collected almost $490,000, so $4,089. If we compare that to claiming at full retirement age, they would collect about $3,100 per month in the gray portion. And so you see a little bit of white space. We'll address that in a second, but those bars grow a little bit more quickly. And by the time we hit that age 76, they would have collected about $8,000 more in total, $497,000 more by getting and waiting for those bigger checks. That's the point at which they would have collected more. And then if we compare full retirement age to age 70, so the gray to the top line in blue, you'll notice that that break-even age is age 80. So that's, again, the age at which claiming at age 70 will give you more in cumulative benefit than the full retirement age example. Now, I'd also encourage you to look over at age 90, because we do just want to emphasize that the longer you live or the more long-lived you are, the more valuable claiming at age 70 can be. So 1.6 million at that claiming at age 70 bar compared to 1.1 with that claiming at age 62. So that's point number two. And then the third thing I want you to just understand is the odds that if you're 62 today, that you might live to those break-even ages or beyond. So the bottom part of the chart shows you for men, women, and one part of a married couple, if you're age 62, the odds that you will live to, let's look at age 80 or beyond. So you'll see it's 6 in 10 men, 7 in 10 women, and one part of a married couple, 9 in 10 will live to 80 or beyond. So pretty high odds. And if the more educated you are, the more income you earn, the better lifestyle choices you make, the more family history you have of longevity, you're likely to be at the higher odds than what you see here. And so just factoring that in is important as well. And the last point I'll make here, you might be asking, Katherine, why are you including a married couple here? I just want to highlight that if you're married and you're both collecting Social Security, if one of you passes away, only one Social Security benefit is collected from then on, and it's the higher one that's being collected across the two individuals. And so if you have a big income difference in your marriage, or you have one person who's earned more than the other, you might want to think about having that individual consider delaying and really maximizing their benefit, because that will be the survivor benefit for whomever in that partnership survives the longest. So it's an important marital coordination strategy to talk to your advisor about. So I wanted to get in a little bit to the future of Social Security, because one of the things that I find many people are curious about, and lots of questions, is, Katherine, I'm worried. I might claim Social Security because I'm really worried that things are going to change, and I'm not going to get what I otherwise would if I don't claim early, and I'm going to take it at that reduced value. So I just want to go through some of the economics of the Social Security program and how Social Security actually works, hopefully to give you some peace of mind there. And again, back to that example of that historical Social Security reform, what we're seeing potentially going forward. So I know this chart may seem a little bit overwhelming, but if we digest it, so the purple line that's going about halfway through the chart pretty steadily across, that is the amount that's collected and is forecasted to be collected from payroll tax collection. So Social Security is a pay-as-you-go system. Current people who are working are paying payroll tax, and that's literally covering the costs of all beneficiaries today who are collecting Social Security. So the green line that you see moving left to right, going a little bit more vertically over time, that is the amount of benefits that are going out the door, the cost of scheduled and payable benefits. The blue line at the bottom is the interest income that's being credited to the trust fund, and then the combination of the payroll collection and the interest income gives you the teal line at the top, the total income, which is that, again, that interest plus tax revenue. So a couple of milestones to look at. If we look at 2009, you'll see the green line, which is what's being owed or paid out, exceeded the amount of taxes being collected for the first time. That's when the baby boomers started turning 62, and we started to need to use some of the interest that was going into the trust fund to cover benefits that were payable. The other thing I'd point you to is 3/4 of the way over on the right. In 2035 is the current estimate of when the trust fund will be fully depleted. And what that means is in that year, about 80% of all of the checks going out the door are going to be covered through payroll tax collection, that purple line. And so the gap is really 20%. I think many people hear, 2035, the trust fund is going to be depleted. That means Social Security is going to be defunct and is going to be completely shut down. And the reality is payroll taxes and collection of payroll taxes is incredibly important and really the driver around the amount of benefits that are paid. And so we'll come back to that 20% deficit in a second, but I wanted to also show you, what I mean by that payroll tax collection coming in and how it is to this point covering benefits that are going out. So this is for 2019. Total income that was coming into Social Security was about 1.06 trillion. And what you'll see is that the income coming in is that payroll tax collection, the interest on the trust fund. And then if your Social Security is subject to tax, that tax comes back into the Social Security program. And you'll notice that this bar is slightly higher than the annual benefit payments going out. So 1.04 or 05 is the amount that went out in total payments. And so one of the things that I know has been floated is, well, what if we just stopped having payroll taxes whatsoever? And I was actually happy to see with the CARES Act, obviously a lever that sometimes is pulled is given a payroll tax holiday, but we know that can really derail the economics of Social Security significantly. So I just wanted to highlight, how large is that trust fund and what could it cover if we just stopped all our payroll tax collection and relied upon the trust fund to cover us going forward. It would cover less than 3 years. A little more than 2.5 years would be what it would be able to cover. So just trying to emphasize again how small the trust fund is relative to what we saw on the prior slide, which was all the payroll tax collection and the income coming in. And so this really gives you some of the mechanics behind Social Security and what's happened historically. So if we look at the top chart, between 1984, so right after Ronald Reagan and Tip O'Neill put the reform in, through 2009, when the baby boomers, as I mentioned, started turning 62, payroll taxes covered everything. And there was actually a surplus, and that is what created the trust fund. Between 2009 and 2021, as I mentioned, we had tapped the interest that was being earned on the trust fund. So payroll taxes plus the interest has been covering all of the payments going out. And beginning next year, it may be earlier than next year now as a result of the high unemployment this year, but either at the end of this year or early next, we will begin drawing on the reserves. And that is what's going to cause the trust fund to be depleted by 2035. One last point here, the CBO released a couple weeks ago an estimate on the impact of the unemployment level this year. And they estimated that it might cause the trust fund to be depleted because, again, less payroll taxes being collected on those workers who are not working due to the unemployment, that it may result in the trust fund being depleted by 2031. So we'll see what actually happens once the trustees report comes out next year, but just wanted to give you that flavor. And so on the bottom part of this chart is showing you if we just changed one thing, if we either increased the payroll tax or we decreased benefits right now, how much would we need to do, or what would that look like? So we'd have to cut benefits 19% across the board for everybody, or we'd have to raise payroll tax by 3.14% in total in order to fill that gap of that 20%. Now we know, though, that there's really no political will right now to change Social Security. There have been some proposals. Biden has proposed the Social Security tax donut hole, where he would begin collecting Social Security tax on people earning more than $400,000. That would cover about 10%, so about half of the gap that Social Security currently has. But obviously, in his proposal, he just didn't propose that increase in tax. He proposed some other changes that would increase costs as well. And so, with the potential for a split government, or we're not seeing Social Security being discussed at all, but we would hope that there would be some bipartisan discussions that would go back and refresh some of the other areas that have been agreed upon in the past. But if I leave you with one thing, as we've looked at proposals from the past, as we've looked at historical reform, I think it's important to note that if you're 55 or older, very unlikely Social Security will change for you. Your benefit formula, your age at which you're entitled to those benefit amounts, that's really set for you. Back to that, passage in 1983 example of how Social Security is majorly reformed. You may pay more in payroll taxes if you're a higher earner, similar to Biden's proposal, but really any major changes we see will be targeted at young people. And that's primarily because young people have a lot of time to course correct and make up for any modifications that are put in place. Just like that move from 65 to 67, people have had over 40 years to figure out how to handle that. But also because older people tend to vote to a much greater degree and tends to be very unpopular to talk about Social Security reform in election years or at all, because that's such a dominant voter bloc, and wants to make sure that they can get the benefit that they're counting on, because they really don't have that time or ability to course correct. So, Juliana, I think the last thing I wanted to cover is just having people think about revisiting their retirement plan in light of major reform that happened at the end of last year. I know that felt like a long time ago, but back to that retirement income equation, one thing we don't have control over is major reform that happens in Washington, and the Secure Act was definitely major reform, and it had multiple elements to it across all facets of the retirement system in the United States. But for individuals on this call, I really would point to the top 2 bullet points on the left under the individual, or in the individual group, because it's a pretty significant change that I think warrants sitting down and rethinking your retirement income plan, and also potentially your estate plan, depending upon how you have your assets transferring. So first, the Secure Act eliminated what's known as the stretch IRA option, which allowed non-spouse beneficiaries, so think children, when they receive an IRA to be able to stretch the distributions over their remaining life expectancy. So if you have, let's say, a 45-year-old child who's receiving that IRA, that's a really long time to stretch that distribution, across their remaining life. Now, with that elimination, all of that IRA that needs to transfer has to be withdrawn by that beneficiary within 10 years of that account owner's death. So back to that example, if I'm 45 years old and I'm receiving that IRA as a beneficiary, I have 10 years to draw all of it out. I can no longer stretch it over my remaining life, which could have been 40, 45 years. And so what that means is that, individuals receiving these inheritances or these IRAs as beneficiaries, they're going to be making fairly large withdrawals if they are significant IRAs, and likely will pay more in tax, or more will be lost to tax. The second major change in the Secure Act is the increase in the required minimum distribution starting age to age 72 from 70 and a half. There's obviously a grace period for this year. There's a holiday, an RMD holiday in 2020. But this, again, will go into effect next year. If you're 72 or older, you must make a required minimum distribution. So essentially, it delayed it about a year and a half. And the most recent Secure 2.0 proposal that was put forth by the House increases that potentially to 75. So you're seeing this kind of as a trend in Washington in moving that required minimum distribution age back. And what the required minimum distribution age is the age at which you must take a distribution, based on a percentage formula to start to realize the taxes that you've been deferring over the course of your life. And so the byproduct of those two, I think, really lends itself to the importance of thinking about Roth conversions and the ability to realize that taxation today while we have the Tax Cuts and Jobs Act in place until 2025, when that will sunset and we'll have higher tax brackets and a more expensive tax code going forward. Taking advantage of those low brackets and that ability to pay potentially less in tax opportunistically to convert to a Roth can get that future tax off the table, would transfer a Roth being tax-free, transfer that tax-free to beneficiaries. That 45-year-old receiving a tax-free account is much different than a tax-deferred account. And also, Roths aren't subject to RMDs, so you can leave those assets in place for as long as possible, and again, get more potentially to beneficiaries. And so what I mean by that is, if we look at the next slide, and this will be my last slide, is we see real value based upon our research in getting to retirement with healthy income tax diversification, that asset location that we talked about on the retirement equation slide. And so what that means is healthy, taxable, tax deferred, and tax-free accounts where you can be flexible and have more control over how to construct your retirement income plan so that you can manage both your taxes, but also how taxable your Social Security may be, or maybe more importantly, your Medicare premiums and surcharges that you may be subject to if you have really high income in retirement. And so this chart shows, how someone can accumulate wealth, kind of left to right in that blue and purple area, accumulate wealth across Roths and pre-tax 401ks or IRAs, so that they get to retirement diversified and using kind of the right timing and the right location in their journey across the tax code to pay tax or prepay tax in that Roth at a lower rate, while when they're in their highest earning years in that blue area, that they're moving all of that into the future and using deductible IRAs or pre-tax 401ks is kind of the best rule of thumb to follow. But two exceptions here. The first circle is for someone who's a mid-career person, probably at the peak of their earning trajectory, and if they're concentrated in tax-deferred assets, so pre-tax 401k or traditional IRA already, we'd encourage you to think about at least contributing to a Roth 401k if you have access to it. Roth 401ks are not subject to income limits, And they're a great way to build up a tax-free pool later in your career if you are in that tax deferred concentrated situation. And then lastly, back to this kind of sweet spot with the Secure Act and the Tax Cuts and Jobs Act, that second circle is what we see a lot of individuals experiencing. They retire in their 60s. They have some pretty low tax years, particularly if they're delaying Social Security until age 70, if they don't have a pension and they're efficiently using their wealth to generate their lifestyle spending needs, they can be paying a pretty low taxes. And so using that kind of sweet spot to be able to convert some of that future tax into a Roth during those years can be really helpful, particularly if you are like what this picture shows, that once RMDs start, you get moved into a higher tax bracket. That's really where that Roth conversion can be beneficial, as well as, again, to that next generation and transferring that asset tax-free, having realized that tax at a lower rate during your 60s. So Juliana, hopefully I gave a good sense of some timely topics from 2020, things to take away in terms of that market volatility and lessons learned and staying the course, the importance of emergency reserve fund, continuing to have exposure to equities for longer term goals. But kind of did a deep dive into Social Security, some things to think about, and also talking about the economics of the program so you can make an informed decision. And then lastly, these concepts of the Secure Act, making sure we're revisiting our plan and reevaluating changes that legislation has put forth, how we can continue to stay the course and make the most of our wealth in retirement, but also transferring wealth to the next generation.
No, Catherine, thank you. It's so much great information. I was jotting down some key takeaways that I'll highlight really quickly that I received out of it. The first is the impact of loss aversion. We talk a lot about behavioral finance here at Principal Wealth Partners, so I think the impact of being out of the market is incredibly powerful. You also talked about the importance of a short-term reserve. I think a lot of people were unfortunate in that experience this year. You also talked about really using time as your advantage, which I think is so powerful. A lot of time on Social Security, I appreciated your comment that it's factual and emotional. I would ask you one question here. Is there one common mistake or misconception that you seem to find, because this is such a complicated topic to get your head wrapped around? What do you find most often the mistake that people make here?
I think the first, individuals where I've seen people, come up to me after I do a seminar, I talk to individuals and go through what I just went through. The most common thing I hear is, wow, I talked to a lot of my peers and they told me, again, I should get it while I can. I didn't understand, the mechanics behind claiming early and what that impact was. And they often say, I wish I could go back and make a different choice. And so I would say that's a key learning for me. I think it's really important for people in their 50s. And I say 50s because that's when these types of questions start to percolate, and you start asking people, for people to talk to an advisor and make sure that they're understanding the facts about Social Security, rather than reaching out to their peer set or others that have gone before them, because there's just so much misinformation out there about Social Security. So I think understanding those facts, and then as you mentioned, putting that emotion and understanding how that emotion plays in too, so that you make an informed decision, is the best thing to do.
I think did you used to have a statistic as to how many individuals on a percentage basis take it early versus wait until it's more efficient?
Yeah, and we've seen some positive trends there. So originally we were seeing about 40% of Americans take it at age 62. That's fallen to about 32%.
Okay.
The next big spike, obviously people claim at 63, 64, 65, but the next big spike is full retirement age, and that's about a third of Americans claim at full retirement age. And then the age 70 has risen to about 8% delay, but it definitely is skewed. Obviously people who don't have other sources of income claim early. That makes sense. The good news is that the people in the highest benefit amount, so the people that have paid in the most, have been the highest earners. We see less than 10% of those individuals claim before age 66. So they're getting to at least age 66. And I think you're starting to see continued improvement when it makes sense for them to delay till 70.
Okay, great. Thank you. You also mentioned the Secure Act, which is one of the largest legislative changes in recent times. So I think it's a great reminder for people that need to either reconsider the plan that they have now, or just update it. So thank you for that. And then the last one is, of course, this Roth conversion. That seems to be a very popular topic. And I think it's also very individualized. Have you seen studies as to how effective the Roth conversions have been in recent times, or is that difficult to read?
Yeah, they're steadily gaining momentum. So when we look at all of the money that sits in the Roth status, right now, what's sitting in Roth IRAs is about equal with what's in Roth 401ks. So you think about people contributing to Roth 401ks, the degree to which conversions are happening and almost starting to dominate the Roth pool is really coming from that conversion activity. And I think it's something that, again, needs to be balanced with what your views are with where taxes sit today for you and the U.S. tax code and where you think it's going. So, if you think the Tax Cuts and Jobs Act will be made permanent in 2026, it may not make sense for you to do a Roth. But if you think it's going to sunset or even go the opposite direction, this might be a good time to get some of that future tax off the table.
Okay, great. Always so insightful, Katherine. Thank you so much for your time. I'm sorry you couldn't meet our clients in person, and we hope that maybe someday you can come out and join us instead of the virtual discussion.
I would love to. That would be great.
No, we appreciate it. And I do hope that everyone has a great holiday season, and we look forward to providing another event shortly. So thanks.